Good Friday morning, Market Chameleon. Everyone join us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Dimitri Pargamanik. How you doing, D?
Good morning, Will. How are you?
Great. You have a little bit of the polar vortex down there in Philly. It's freezing up here.
Oh my God, yeah, it's really cold. Really cold.
Really cold. You want to start with the disclaimer?
Yeah, I don't think you have it up though.
Oh, really?
I'm going to switch it up. Yep. So while Will's doing that, just to give you guys the disclaimer, Will and I and Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. Well, I think you took it down again. If you need advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice, provide you with guidance. There's a disclaimer, and I'm going to share my screen now.
Perfect.
Righty. Anyone joining us for the first time? The reason we do this show is to answer any questions you may have about Market Chameleon tools, data analytics. If you want to talk about some strategy or something unusual you've seen, you're welcome to come on a show, ask those questions. One way is to put your question on the live chat on YouTube, type it in, Will's watching it, he'll read them back to me. If you want to come on a show and ask your question live, we also provide a link to Zoom. Click on that link. That will take you over to Zoom. Once you're in Zoom, there's a button, raise your hand. Click on that. You don't have to turn on your video camera. Once we let you in, you could ask your question live and direct. Everyone could hear it. While we're waiting for questions to queue up, we'll start taking a look at the pre-market report, see what's trading at pre-market hours. If we don't get any questions coming in, what I'll do is move to some of our earnings reports to get some insights on earnings. We've got a lot of earnings coming out right now, a lot of technology companies. So let's just take a look at some insights around the earnings. Of course, if we do have questions, I want to try to get to those first. Sound good, Will?
Perfect.
So pre-market, right now, these are stocks that are trading in the pre-market hours. We have our most active stocks, our biggest percentage gainers and biggest percentage decliners. Here I see 44 stocks made our percentage gainers list, 184 in the decliners list. From this perspective, we are looking like we're setting up for bearish bias at the open. Couple things. Yesterday, there are some big earnings, Google, Amazon, Apple. All of them look like they reported somewhat weaker, earnings, sales. Some even reported some weaker forward-looking statements. So they're off a little bit today, but we've been rallying for so much that they're giving some of it back. So not terrible, but some of it back. And I think also we had a unemployment
jobs number,
jobs number, and the jobs number looked really good. And of course, that is positive for people who are looking for jobs, but that makes things tougher on fighting inflation, because if wage inflation is considered sticky, and if there is wage inflation or pressure from low unemployment, you have to compete, right, to hire people. That produces inflationary pressures, forcing the Fed to fight inflation harder than they have been up to now. So those are like the things right now that Wall Street is grappling with. But let's narrow down this list, because the first list, as you could see, there are lots of stocks in there that could be small cap stocks. There are ETFs in there, leverage products, anything that trades on the major U.S. exchanges that's trading at pre-market hours and meets our thresholds can make this list. Let's narrow this list down to a group of stocks, and I just like to start out with the S&P 500. So to narrow this down to the S&P 500, I'm going to use the filters here. This one in ETF. When you click on it, you see a list of ETFs to choose from. The SPY ETF, first one is the S&P 500 ETF. When you click on that, the list below will get filtered by stocks that are holdings in the SPY, which are the S&P 500 constituents. Here we see 1 made the percentage gainers list and 43 made our percentage decliners list. That is shown, a more bearish bias at the open. And up here on the decliners list, you see Ford, Amazon, Google. These alerts here are letting us know they just reported earnings, either yesterday after the market closed, today before the market opens, and in the pre-market hours, people are reacting and trading on earnings news. So let's do this. If we didn't have any questions pop in yet, I'll move to some reports, take a look at, some insights on earnings. Well, all right, I think Will's computer is frozen. I don't hear him, so I'm gonna just move on. If he gets back with a question, I'll stop there. Let's go to the earnings here. Under earnings, we see a earnings stock moves. And right now, what this is tracking stocks that reported earnings recently, and then after they report earnings, we track what did the stock do? What did people, bid up the stock, sell off the stock? What tended to happen during this earnings season? And we could compare to what typically happens. And let's narrow this down to the S&P 500. I'm going to drop this down, and I'm going to select this SPY holdings. This will filter out stocks that are in the S&P 500. And here we see up top that 52% of the stocks so far that reported earnings, doesn't matter, beat, miss, doesn't matter. What did the stock do, right? Because the stock will move on, not Wall Street, consensus estimates, but really the estimates of different traders' opinions, right? So what did the stocks actually do, after looking at earnings, forward-looking statements, all that? 52% of the stocks were up after the report, 47% were lower. On average, there is a gain of 0.8%. Okay, what does that mean? Well, if you made the same notional bet on each individual stock day before, sold the day after, on average, a 0.8% gain. So let me just come down here and show you how that compares to a 3-year average. So this is looking at the same group of stocks. So far, there are 229 stocks that we captured. And it's looking at that same group of stocks, what they tended to do. And you see on 3-year average, it's 50-50 with break even. So fourth quarter, you could see here that's better, doing better than that average, for an average gain of 0.8%. If we compared it to the previous quarter, 57% of the stocks were up, previous to that 58%. So even though you guys could see here that we are kind of in a bear market, things were not good as far as the stock market total returns. But if we just isolated it to the day of earnings, the stocks so far in the S&P 500 tended to be up more than down. Maybe that's just where, too much pessimism was priced into it, or, that's after earnings, that's when the buyers felt more comfortable coming in. But that's a one-day return after reporting earnings. Let's take a look at NASDAQ. QQQ, we see a similar situation. So in the NASDAQ, it's a little bit different. there are more stocks that declined 58% versus that were up, but on average they still gained 0.3%. So how's that? How does that work? Well, that means that the ones that were up by a bigger percentage move. There were some big moves there that offset, the others, because obviously your averages could get skewed. If you have really big move to the upside, that will average out, smaller moves to the downside, right? So we could see here that more often they were down, but on average they did gain 0.3%. Like we saw, Meta, right? Meta was up over 20%. Well,
yeah, it was a huge move yesterday.
Really big move to the upside. Now, keeping that in mind, what tends to happen, we could say like, well, if more often than not companies are up after earnings, let's say that's assumption, let's take a look at another report. We could look at the options and see, well, what did the options do if I looked at that strategy? So I'm going to go here to options, and let's look at the earnings option strategy screen. And here we kind of just want to maybe validate some thesis, right? We don't know going forward what will happen, but maybe we just want to validate a thesis. And I'm going to just create one right now, okay? And this has over 3.3 million back tests looking at different strategies of how these strategies performed around earnings. And let me create a thesis where I'm going to say, I'm going to look at the S&P 500 companies. So in ETF, I'm going to say S&P 500 companies. So this big thing is going to now filter. This is a really big report, by the way, so it's going to take some time. You have over 3 million entries. I don't even know if Excel, I think it's right. What do you have? Like the most is 1 million rows, maybe. So we narrowed it down. And now let's say we want to take a look at a strategy that's just long a call. Forget about straddles. What if we were just long a call and at the money call, right? And if we were long that at the money call, so now we narrowed it down to 3,380. And let's say we did it one day around earnings. Bought a day before, sold it the day after, right? So day before and then day after. And so I gave it a time range, a hold period, gave it a strategy around the earnings. And I have all these listed stocks. Let's sort this by market cap. So I'm going to click on the market cap here. It's going to resort the list. Let's do it by highest market cap. So here, Microsoft, Tesla, NVIDIA, Meta, all of these are up here. And you could see here, that's a strategy long at the money call, one day before, sell it the day, or they reported earnings, the day of that close. And here, it's looking at the last 12 observations. 33% of the time, that call was profitable, the rest unprofitable. Microsoft, and you could see on average lost 14%, the median return down 56%. This is the best and worst return. So it did have a return of 244%, but it also had times where the call just lost completely 100% of its value. That's the standard deviation and chart. So going down here, I'm just eyeballing it. I got a lot of negatives here. That didn't look like a great strategy to me to do around earnings. So maybe that thesis wasn't correct. But what if I changed my thesis and said, you know what? Yeah, earnings, who knows? Sometimes they're up, sometimes they're down. Nobody can predict it. But what What if I changed the thesis and said, maybe the call was better heading into earnings. Forget the earnings. What if we started out 1 week before, thinking that people are going to start buying the stock, buying implied volatility, buying the options, and keep that pressure up right up to the day of the earnings? How did that do? Right? Let's take a look at that thesis. So I'm going to keep it on this strategy, just to make it simple. Let's stay on one strategy, but we're going to change the time frame. And now the thesis is going to be, well, my thesis is that, that traders start to come in. Traders know when the earnings are happening, right? So the company, issues a press release, puts it on their web investor relations website, or you could go to our earnings calendar, and you know that the earnings are coming up. So knowing that, you might start positioning yourself ahead of that period, maybe starting a week before, and then it starts to, pressure builds up as you get closer. And my thesis is, okay, maybe that's when people start kind of accumulating the stock and start buying options, driving both of those higher. So that's the thesis. Let's just test it out and see what the results were historically. And if you want to look at the results, by the way, you see this 12 that shows you the observations. If you click on it, it'll take you over, and then you could see here are the dates, right? What the option was before, what the option was after the return, and what the stock did. And if you want to open up the options chain, click on there, and it's going to open up the options chain to show you the snapshot of the observation. This is a little slow, but here's the options chain snapshots. Okay, so you could dig deeper in there. But let's go back. I'm going to close this. Let's go back here. Let's change those assumptions. I'm going to say 1 week before and the day before. Forget about earnings. Let's just look at a different time frame, because we know that, yes, earnings is the actual event, the liquidity event, but the trading starts before it, right? You can't, once the markets are closed, you can't put on a position. So any positions that you're trying to average into or accumulate or whatever, you'd have to start heading into it. All right. So now we got long at the money straddle. Long at the money call. Start time heading 1 week before earnings. Okay, so it's 5 trading days, and you close out the day before. So the idea is that the day before earnings, the implied volatility will reach its highest point, right? Because that's where the maximum, where the trading is the maximum implied volatility. The thesis is will reach its highest point, and if we start a week before, what would help us is implied volatility and people putting on the stock, buying the stocks heading into earnings. So we could see here a little bit different situation all of a sudden. So Apple, we could see here, that was a 67% winner with an average return of 27%, median return of 20. So all of a sudden, that call, actually, if you're playing the call, just buying naked call and holding on looks much better if we just changed the time frame, right? If we just changed our thesis, said, let's look at it from a different perspective around earnings. So you could see Microsoft here, 67% winner, not all the time, but here we could see that even here, Amazon, 42%. In other words, 58% of the time it did lose value, right? But the times, remember that with average, when we're averaging things out, right? If you get a big move in one, you can pull up the average. So 17% return on average. Meta, 58% of the time with a 20% return. And look, the thesis is the following. Not only, the implied volatility might start heading up, and hold. So what we're doing is saying, I don't anticipate a lot of decay in this option. And on top of that, you think that people start buying the stock heading into it, and maybe something else happens that could make the stock move even prior to that. So you might still get a binary move before the earnings. There's a potential to get that binary move too. I mean, in either direction, but you still have a chance, right? So that's another way of looking at it, and they look a little bit better. Let's now change our thesis again, right? Based on this right now, it looks to me like at least historically, playing the long call at the money call look better doing it starting the week before, getting out the day before. Let's change the thesis again. What if we said, all right, forget about the week before and forget about the day of earnings, right? That's a lot of uncertainty. But what we do know is that, well, once they report earnings and the stock moves, well, there's a lot more certainty, because now maybe people feel more comfortable getting into the stock because now the news is out and it had a chance to reprice up or down, right? Based on the news. And maybe now people feel more comfortable, starting to accumulate the stock. In addition, we know that after earnings, there are a lot of people who start unloading their option positions and driving down the implied vols. So maybe the thesis should be that I could pick up a cheap call after earnings, so waiting for that implied volatility to sink, and it could get cheap enough that if I hold it and people start, and that there's more certainty that the stock will start getting, start recovering or continue to rally because the certainty is out, and now people could put their VWAPs back in, people can put their orders back in and say, okay, now I'm more comfortable. All right, so I'm changing the thesis again, and I'm going to change the time frame. Everybody with me? So let's do this. I'm going to keep it at the money call, S&P 500 companies. I'm going to say that we are going to start. So we're going to hold it for 1 week after. Okay. And we're going to get the option 1 day after the earnings. So we're going to let the earnings come out. We're going to let the stock do whatever it does to reprice, give it a whole day to let the stock reprice. And then we're going to let the options implied volatility also reprice down, let everybody dump their options back out, put their positions back on, drive that implied volatility down. Then what happens? All right, so now we're looking at a different picture here. And we could see here that Microsoft here, 58% winner for an average return of 24%, right? Median return 14%. And sometimes you get wiped out. You're going to buy an option, goes to zero. But historically, doing that strategy on average was a winner. Okay, remember, we're not looking at one instance, two instances. We're just saying what tended to happen. Tesla looked much better. So here 75% of the time that the stock did what it did, and the option gained value for 104% return. So you can see there are times you get wiped out, right? Worst return, completely lost. But we're looking at averages here. Okay, guys. NVIDIA, here's interesting, was only winner 33% of the time. But what we see is that there must have been times where you're winning so big that the average is still worked out in your favor. So let's take a look at that. I'm going to click on NVIDIA. Right. And here's NVIDIA. These are the dates. Okay. This is the strike. This was what the call was before. This is what it ended up after. So you could see here, November 16th, the 155 strike, which would have been the at the money. The call was $3.25, let's say. But after 1 week, look what happened. See, this was the stock. The stock was 154. 1 week later is 165. It went up 7.2%. So that call went from 325 to, let's say, $10, right? 216% return. So you could see that the times those winners were pretty big, so you have some big losers, but remember, when you own a call, you could make more than 100% return, right? So you could see here that the winners tended to be very big, pulling those averages up. All right. Let's come back here. And keep in mind, this is not during earning. This is waiting the day after earnings. Okay. So this is a strategy that says, okay, I'm waiting, let the earnings come out, whatever they do. I'm looking to see if I could scoop up a cheap potential call with the, with the outlook that this could rally for the next week. And of course, you have some more. Here's, I think this is MasterCard. Same situation here. Wasn't a winner most of the time. The majority of the time it was a loser, but those big wins on average offset those losses for an average gain of 21%. Okay. So it's looking at things to kind of looking at different theses and saying, well, wait a minute, like if I'm looking at this data from a perspective of just being long a call, it looked to me like the dates straddling earnings were better, showed better returns, better risk reward than just plain the earnings itself, based on that historical data. So we're right up at 9:30. Well, I guess no questions.
We did have one question from a new chameleon, Christoph. He was asking, what days to expiration is a long at the money call strategy?
So when we look at the options to pick out the long at the money, we always look at the expiration month, the first expiration month that covers the earnings. Okay, so we're always looking at the nearest month that has to cover earnings. Okay, so there's no exact days to expiration each time, because there's no way you could get exact days to expiration every time, because you have limited days to expiration, right? Sometimes you'll have a expiration that only has 2 weeks to go. Sometimes it could have 3 weeks to go. Sometimes a week to go, right? But the option has to cover, the days that we're looking at, and then the expiration, and then the earnings. All right, so that's what it's looking. So you could go back and, if you click on the data, you could go back and look at the options chains yourself by clicking on it. So here's, February 3rd, that's the expiration that we used on this one. January 26th, the snapshot before. February 1st, the snapshot after. So you could open it up and look at the snapshot that we used in that analysis.
Awesome job, Dima. That is the opening bell. We did have a question from Chris. I'll send it to you. Maybe we can look at it on Monday. He said, since earnings skew volatility, is there any option strategy to take advantage of the vol skew, like doing a calendar or selling higher front month and buying the back? I'll send that question to you. Maybe we can look at it on Monday.
Okay, sounds good. All right, everyone, thanks for joining. Stay safe out there. Have a great trading day and hope to see you guys on Monday.
All right. Great, everyone. Have a great trading day. Thanks so much, D. Everyone, enjoy the weekend. Bye, my friend.
Bye, Ryan.